Have you ever looked at SCHD in your portfolio and thought, is this thing broken? You picked it for steady dividends, reliable companies, and dependable growth. But lately, compared to the flashy tech stocks dominating headlines, SCHD feels like it's just standing still. And when an investment looks stuck, it's natural to wonder if it has lost its strength, or if maybe something bigger is happening under the surface. That's what we're uncovering today, because SCHD may not be as weak as it appears. In fact, it might be quietly building for its next move. Stay with me until the end, because once you see the full picture, you'll understand why this so-called boring fund could surprise a lot of investors. So why does SCHD look flat? The biggest culprit is interest rates. Think of rates like gravity, invisible, but always pulling. For years, U.S. Treasury bonds paid next to nothing. Put $1,000 in bonds and you'd barely make enough for a cup of coffee. That forced investors to chase better yields, and many landed on dividend stocks. SCHD, paying around 3 to 4%, became an easy choice. But then, inflation surged. The Federal Reserve slammed on the brakes, hiking rates again and again. Suddenly, government bonds weren't paying 1%, they were paying nearly 5%. Guaranteed, backed by the U.S. government, no volatility. If you're a pension fund manager choosing between a risk-free 5% treasury or a basket of dividend stocks that might fall 20% in a downturn, the choice is obvious. That shift pulled money away from dividend ETFs like SCHD, pressing down on their prices. So here's the important detail. SCHD's dividend yield only changes in two ways. Either its companies raise dividends over time or the stock price falls, making the existing yield look larger. Until bond yields come back down, the market keeps SCHD's price in check. That's why it feels stuck. Not because the businesses are collapsing, but because yields elsewhere have created a ceiling. Meanwhile, the S&P 500 soared, but it wasn't broad participation. The rally was led by just a handful of mega-cap tech stocks fueled by artificial intelligence. Those names sucked in money like a black hole. SCHD, however, has strict rules. Companies must have at least 10 years of dividend payments, strong balance sheets, and high returns on equity. That automatically excludes the Teslas and Nvidias of the world. By design, SCHD skipped the AI-driven surge. That's the second reason it looks weak. It simply didn't own the names pulling the market higher. Was that a mistake? Not at all. It's exactly how it was built. But it created a big opportunity cost for investors watching the index soar while SCHD sat quiet. Now here's where the story shifts. Every March, SCHD rebalances. No emotions, just a rules-based algorithm. And the most recent rebalance was actually one of the biggest in its history. 23 companies out, 23 new ones in. That's about 20% turnover. So, why the shakeup? Well, one former top holding was dropped, not because the business collapsed, but because its price rose so much that its dividend yield shrank to barely 1%. The math basically said you no longer qualify. Other well-known companies like Pfizer and BlackRock also got removed, probably for failing quality screens on debt or profitability. And what came in? A big pivot toward energy. Suddenly, nearly 20% of SCHD's portfolio is oil and gas. ConocoPhillips and similar names climbed into the top tier. Consumer staples like Hershey were added too, but honestly the energy shift was the most dramatic. This means SCHD isn't the same fund you owned a year ago. It has tilted from defensive staples and healthcare toward cyclical energy. That adds risk. It may swing harder, but also opportunity, since energy can thrive when demand and prices rise. On the outside, SCHD looks flat. Inside, it's been completely rewired. So let's connect the dots. SCHD looks weak because first, high bond yields capped its price. Second, it missed the AI surge by design. And third, it just rebalanced heavily into energy. None of these mean it's broken. In fact, they may be setting up the opposite. Market leadership always rotates. Tech dominated in the late 1990s, then value came back after the dot-com crash. Oil and housing led in the mid-2000s. Blue chips ruled after the financial crisis. Then growth tech reigned for a decade. Now AI names are in the spotlight, but no sector holds leadership forever. Eventually the cycle shifts back toward value and dividends. and SCHD is built for that rotation. Interest rates are the second piece of the puzzle. The 5% Treasury yields pulling investors away won't last forever. If inflation cools, unemployment ticks up, or the economy slows, the Fed will cut rates. The moment they do, the gravity holding SCHD down flips into a tailwind. Imagine Treasuries dropping back to 3%, while SCHD still pays around 3.8%. Suddenly, SCHD looks far more attractive, especially with potential for price gains. Let's look at three possible scenarios. First, a soft landing, inflation cools, the Fed cuts gradually, and dividend stocks shine. SCHD could rally strongly. Second, a strong economy with sticky inflation growth stays solid, but rates remain high. SCHD's energy holdings could thrive, but yields keep it capped. Performance muted but steady. And third, a recession. Almost everything falls, including SCHD. But its high-quality holdings would likely drop less than speculative growth names, acting as a defensive anchor. So no matter which outcome plays out, SCHD has a role, thriving in a soft landing, holding steady in sticky inflation, or protecting in a recession. Here's another hidden detail. Wall Street analysts recently compiled price targets for SCHD's underlying companies. Weighted together, they suggest an implied upside of nearly 11% over the next year. No guarantees, of course, but it shows that professionals looking at the fundamentals see value beneath the surface. That's why it's critical not to confuse temporary weakness with permanent decline. SCHD is like a coiled spring. 2 years of high rates have pressed it down, but the longer the pressure lasts, the stronger the snapback potential once conditions shift. Does it carry risks? Absolutely. Energy exposure means more volatility. Oil prices and geopolitics can swing results. Rates could stay higher longer, but, that's the trade-off for opportunity. So, should you dump SCHD out of frustration? Well, that depends. If you're chasing the hottest trend, no dividend ETF will satisfy you. But if you want disciplined, income-focused investing that can quietly build strength while waiting for cycles to turn, selling now could be a mistake. The irony is that the same factors making SCHD look unattractive today, high rates, missing speculative AI stocks, and a shift into energy, are also the ones that could make it shine tomorrow. That's why the chart doesn't tell the whole story. The fundamentals do. So when you glance at SCHD in your portfolio, don't mistake quiet for failure. Sometimes the most overlooked investments are simply waiting for their moment. And when that moment comes, the growth that feels impossible today could look unstoppable tomorrow. If you found this breakdown helpful, make sure to subscribe to MoneyQuest Broker for more insights like this. And just a reminder, this is not financial advice, it's for educational purposes only. Always do your own research and remember that all investing involves risk.